carefully. Now, when it comes to beneficiary options, spouse beneficiaries have options that are available to them that are not available to other beneficiaries. And so for them, we have to be even more careful. And here's why. The spouse beneficiary can treat an inherited IRA as their own. For instance, if it's an employer-sponsored retirement plan, that can be rolled over to the spouse's own IRA. And the question becomes, should a spouse beneficiary treat an inherited IRA as their own or roll over an employer-sponsored retirement plan that they inherit to their own? And the answer, as it always is with most questions about retirement accounts, is it depends. Here are some of the reasons why it depends. Is your client who inherited a retirement account from their spouse on the age 59 and a half? If the answer is yes, will they be taking distributions before reaching age 59 and a half? If the answer is yes, then they should keep those assets in an inherited account. Why? Because distributions from inherited account or beneficiary account are automatically exempted from the 10% early distribution penalty. The IRA custodian or trustee is required to input a code 4 in box 7 of 1099-R for distributions from those accounts. And code 4 lets the IRS know that the distribution is exempted from the 10% early distribution penalty. Now, when a spouse beneficiary chooses to transfer inherited assets or keep inherited assets in a beneficiary account, they can change their mind later on. So they can eventually transfer that amount to their own retirement account. But if they put it in their own retirement account, they cannot go in the opposite direction. So there's this case that I use in many of my presentations where this woman inherited an IRA from her husband, and she knew enough to know that distributions from inherited assets are exempted from the 10% early distribution penalty. But what she didn't know is that the minute she moved it to her own account, that she lost that exception. And that cost her almost $8,000 because she took the distribution after the assets hit her own non-inherited account, disagreed with the IRS that she owed the 10% penalty. The matter was referred to the court, and the tax court said, well, you lost that exception the minute you moved it to your own account. So be careful how you advise spouse beneficiaries about which options they should choose. And in my handout, I included some case studies that shows when it might be beneficial to move those assets to the spouse beneficiary's own account versus keeping it in a beneficiary IRA. Let me paint you another scenario. You might have a spouse beneficiary client who doesn't want to take distributions because they inherited the boat, the car, the house, and the IRA. And they're thinking, well, I don't really need to take distributions from the IRA. And so the challenge for you is which option would give them that as a solution or take them as close to it as possible. Now, here is an example. If the account owner died before the required beginning date, before they were supposed to start taking RMDs, then the spouse beneficiary can keep the assets in a beneficiary account and would not need to start taking required minimum distributions until the decedent would have reached age 72. And once that time comes, the single life expectancy table would be used to calculate those distributions. But the single life expectancy table produces a larger RMD amount than the uniform lifetime table. So the strategy is